You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. Welcome to Options Bootcamp, the program where we break down all of the interesting options, educational topics, the strategies, the tips, the tricks, the techniques for you. The basic, maybe you're getting a little bit more sophisticated. Retail, stock trader, you want to dip your toes into those options waters. We're here to help. We're your lifeguards. We'll pull you out of the deep end before it gets too dangerous. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which you are enjoying this program right now. If you like what you hear, make sure you leave a review. Other folks can continue to discover this program. We love it. You guys are loving the return of boot camp, the fact that it's been upgraded to every week as opposed to once or twice a month. Seems like you guys are really loving that. So we're endeavoring to get it out to you as frequently as possible. If you want it in your ear holes instantaneously, you don't want to wait a week or two between episodes, then the live stream is the easiest way to do that. You get a jump on all your fellow podcast listeners over there. So if you have a question, like we just talked about time spreads. Wow, what are the answers to some of your questions about? You don't have to wait a week. We're doing it right now live. So join us live. When we do these, like to tweet these out and put that out there. So stay tuned to our Twitter out there. It's probably the best place. Of course, our website will have the live schedule there as well. So if you want to know when we're doing Bootcamp Live, check the website or check our Twitter. We'll get it out there for you. And joining me once again to parse all things options edumacation, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to Options Bootcamp, sir. It has been too long.
Oh, it's been so long. I can't believe it. Yeah, it's really good to be back, Mark.
Do you remember how the show works? It has been a while.
Yeah, I don't know. I think we start at the beginning, right?
Start at the beginning. So we talk about Alpha, the A Greek. All right. Before I confuse you even more with nonsense Greeks, let's bring on, what should we call him? Let's bring on the options rats himself. Just kidding. Let's bring on our old friend, Mr. Matt Amberson, the founder over there at ORATS, holding down the NASDAQ hot seat once again. Mr. Matt, welcome back to Options Bootcamp, sir. It has been too long for you as well.
I need my fix. Let's get going, Mark.
All right, let's do it with a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Like the man said, this is the portion of the show where we read your letters, your carrier pigeon missives, your social media tweets, all that good stuff. You know how to find us at Options, most of the major platforms. Questions at the Options Insider, our website, feedback form at theoptionsinsider.com. No shortage of ways to find us out there to make your thoughts heard, and a lot of you did just that about all things time spreads. We just got off a very long and detailed time spread revisited episode, so check that out if you have questions about this, and of course go back into some of the earlier episodes. If you haven't done so already, go back to episode 1 and really get started from there. By the time you get all the way up to where we are right now in the 80s, I believe, you'll feel pretty armed for this conversation, because as we said last episode, time spreads are a bit of an options 201, maybe even an options 301 type topic. So if you're not comfortable with them, not really that knowledgeable about them yet, don't worry, you're not alone. And it's a good time to arm yourself, because you got a little time right now. And these are interesting times to be looking at and indeed analyzing, and perhaps even trading time spreads. So let's get to some of your questions. First off, regular questioner here, Scott Somer. He sends in a lot of questions for a lot of our shows. This time he's asking, I think this came in actually, Dan, on the heels of our last show, because we were talking about time spreads actually 2 episodes ago. I think with Luke from Equity Armor, we were talking about answering some of your questions then, and Scott chimed in on that show to say, if you choose to diagonalize your time spread / calendar spread, do you prefer to move one option to create a credit spread diagonal or a debit spread diagonal? Remember, listeners, your traditional time spread is going to be your at-the-money calls. Examples we use on the last show with an NDX approaching 9,500. We looked at a June-July 9,500 time spread in the NDX, where you're buying the July 9,500, selling the June 9,500. If you understand basic Greeks, you understand that July is going to cost more. It may have more premium, more vol premium, more time premium baked into that. So there's going to be a cost to that. And in that case, it was about $122 for that trade. Now, Scott's asking if you play with that a little bit and go to the diagonals, which we also did on the last show. In this case, we opted for a diagonal, a debit spread, aka we paid for this one. So we turned around and we bought the 9,600 call this time in July, and that one cost about $282, and then we sold against it that same 9,500 call in June. That one was about $218 or so, so we got about $66 we had to net outlays. Obviously cheaper, but still a debit. So that's the example we gave last time, but that is by no means final. Let's go back to the guy who kicked off this whole conversation when he had the temerity to invoke time spreads on this show. Dan, who knew the tweet storm and question storm you would unleash as a result? What are your thoughts here for Scott's and others about when you're doing diagonals? Do you like to go debit spread or credit spread diagonal, sir?
You know, I feel like it's very important for traders to focus on something different than whether it's a debit or a credit, because the fact of the matter is it really does not matter at all. Like this is where time spreads are a little bit more cerebral than some other strategies. Like they're like, you have to do the same analysis that you do with other strategies, but then there's a couple things layered on top of it. It definitely does not matter either way, whether it's a debit or a credit, which kind of seems weird at first, you know, but it just doesn't matter. What you should care about are a couple of things. One, the implied volatility relationship. The skew, like, am I buying a cheaper volatility than I'm selling? Very important. You should also pay attention to the profit and loss diagram. Always model these things out. See, where does it have to go for me to, reach my maximum profit? Where does it have to go for me to reach my minimum profit? What's my, or maximum loss rather? What's the projected break even? And does that fit my forecast? And then the third thing, of course, to look at is the Greeks. Does this delta fit my forecast? Does this theta accomplish what I'm trying to accomplish for me? What about my volatility? My Vega. If I'm playing a volatility skew and they converge, which is probably what you want to have happen, like how much would that make or lose me? So yeah. Don't think about it in terms of debits and credits. I know that sounds really, really crazy, but I mean, it doesn't really that much matter. I guess we can throw one other fourth thing in to look at. Look more at return on risk. Like, how much do I have to put up in margin to carry this position? And then if I reach my maximum projected profit, what is that as a percentage? Because it doesn't matter if I pay zero for it. If I make 50 cents, That's not infinity profit. It's what did I put up to carry this position in margin versus that 50 cents.
The audience always fixated on debits and credits. That's why I wanted to start with this one. That's where their mind often goes first. And you're right, Dan. It doesn't really matter at the end of the day. Mr. Matt, same question for you. You like to back test all sorts of flavors and variants, debits, credits, diagonals, calendars. What do you have to say here for Scott and everyone else out there who's obsessed with the premium, sir?
Yeah, everything that Dan said. Look at the risk, return, look at the volatilities, how they relate to each other, how they've related to each other historically. But I will say this, from all the back testing, it comes down to you want to pay as little as possible. And I know that sounds a little bit like a tautology, but what you want in these is you want to give yourself the Mount Vesuvius payoff, but pay as little as possible for it. So sometimes that diagonal. So I mean, to answer Scott's question is, I like to do the diagonal where the longer term one is more out of the money, so you're paying less for it. And you could even structure it where you could get a credit for if you do long enough time and big enough of a separation, you could have a long calendar with a diagonal and get some money. That's even Dan mentioned the poor man's way to do a buy right. Well, this is the poor man's way to sell a put, is to do it in such a way that you're doing it with a calendar. So that's what we found in the testing, in the back testing, is you want to pay as little as possible for it. But you want to have that risk reward as high as possible, Mark.
All right. Before we move on, really quickly, a lot of you had questions about the Philly floor reopening, including Scott Somer. He had another question. He sends in a lot of questions about. He wanted to know specifically about, is the NASDAQ PhilX floor going to be open? Everyone's talking about trading floors reopening in the wake of NYSE actually is open right now. This is the show, the NASDAQ Hot Seat. We did reach out to NASDAQ and asked them specifically, hey, what's the deal with Philly? They sent out some information that they don't have a specific opening date yet, but they updated their manual on the 22nd for what's going to be required when the floor does come back. You have to have a temperature reading every day. You have to pick up hand sanitizer and face shields every day and keep them at your assigned workspace for when you do come back. So they are making preparations to come back, but it sounds like that Philly floor, no specific opening date. I'm sorry, Scott and everybody else out there who's asking. We don't have a specific date for you, but we'll stay on top of that. All right, next up, back to time spreads. Indelia. Indelia wants to know, what is the right environment for a time spread? Mr. Dan, since you kicked all this off by saying the time was right for time spreads, let's dive in here for Indelia. What do you like to see? What's the setup you like when you're looking at a traditional time spread, sir?
Yeah, I mean, as far as the traditional time spread goes, like Matt has been talking about basically the profit and loss diagram, the Mount Vesuvius. If I think that a stock is going to hang around like a certain level, like kind of trade in a range, like the stock's at 85 now, and I think in another week or two it'll still be at around 85, or even if a couple of days could be the time horizon. That's a great starting point. But then the setup becomes really, really simple. Does the volatility skew exist? Can I sell the short-term option at a higher implied volatility than the long-term option that I'm buying? Because if that answer is no, then stay away. Like, it doesn't benefit you. You probably do it with some simpler trade, iron condor or something like that. But if I can get that skew, I put myself at that statistical advantage that we've been talking about. So in a lot of ways, like once you really intellectualize it and get it down, the analysis becomes really pretty simple. Do I think that by the expiration of the short-term option will be around this price target? And is there a favorable volatility skew? If the answer is yes, but boom, that's it. That's the analysis can be that simple.
That's why time spreads are often popular around times like earnings, because that usually causes a nice little pop in the volatility term structure out there that you can take advantage of if you're using diligent time spreads out there by maybe selling the month that you think is overpriced and buying a month that you think is underpriced from an overall vol perspective. But you're right. As I mentioned on the last show, time spreads, this is why I kind of call them somewhat counterintuitive. Matt has mentioned multiple times now that Mount Vesuvius payoff graph. If you don't know what he's talking about, listeners, just put it into your whatever you use to analyze options trades, and you'll see that options P&L graph for the time spread looks like a Mount Vesuvius. It spikes, it peaks right in the middle. And that's why I say this is often a counterintuitive type strategy, because you often have a scenario you want to buy it. As Dan mentioned, you want to take advantage of that favorable volatility skew, that term structure. But also, at the end of the day, you want essentially a scenario for the traditional time spread where you want the underlying to not really do much, not do a heck of a lot. Hence, that Mount Vesuvius, that peak right at the top there. You're buying premium, but you want the underlying to sit, which is kind of why this is one of those strategies that takes a little while for people to wrap their heads around. Matt, I'll give you a chance to chime in on that. And also, because we got so many questions, I want to squeeze more people in here. Let's also add in this one here from B6. Maybe he's a cousin of BB8 out there. I don't know. He says, I've mostly heard it said that the most you can lose on a time spread is the amount you pay for it. But since you're short more gamma than you are long, can't you potentially get hit in an extreme market downturn where you are losing more on the front month contract than making on the second contract? Interesting comments. So this is, of course, getting out there to that fact that's widely disseminated out there about time spreads, that you pay that premium for it, and that is your risk. That is exposure to the trade. But as B6 points out in an interesting fashion, of course, you're short gamma in this trade. And that can make things interesting. Let's say, a month and change ago when we were hitting limit downs, for example, in the broad markets. That's when things start panicking, and things in the front month tend to blow up. And maybe a few months out, you don't tend to see that type of thing. So, Matt, a double duty for you. First, if you have anything to add on Indelia's question about the right environment, have at it. Then B, what do you have to add here for Mr. or Mrs. B6 who wants to know about being short gamma in that front leg? Can that come back to bite you?
Yeah, I find it somewhat counterintuitive as well, because you do want it to land on a certain strike. And so that's, if you don't want it to move around a lot, that's short gamma. But you do want the premium that you own to be as high as possible. So you have a long vega position and a short gamma position, which doesn't usually happen. And if you have the same strikes, and that's why you have to you have to refrain from gamma scalping, because if you have the same strikes and no stock position, and dealt crazy things with dividends notwithstanding, it's the amount that you pay for it that you can lose. So, even though you are short gamma, you're short gamma right around that strike, and but long vega because you're long that the longer term option. So it's counterproductive. But again, know the position you have, know what you can lose, and that's when time spreads start to make more sense, Mark.
Yeah, for a certain segment of the audience, I'm not sure if they'll ever make more sense, but they can make more sense. You're right. There's so many counterintuitive areas of this to explore. Dan, same question for you, particularly there with Carmela, B6, who's confused about the notion that all you can lose is the premium when in fact you're short gamma, and that could come back to bite you, sir.
Yeah, I mean, I feel like the answer to this question, like, can you lose more than you pay, doesn't relate so much to because you have negative gamma. Because if you're doing it correctly, I guess I would say the normal answer should be no, because whatever you pay ends up being the most you can lose. You get far enough out of the money and you no longer have gamma, and your two deltas offset each other. However, if you are not managing this trade to the best of your ability, I can imagine a scenario where you could lose more than you paid. Like, for example, say I buy a put time spread right now, and I just forget about it, the short put expires, but I keep the long put on, and then the stock ends up going south and puts that option in the money, and when it expires, I get automatically exercised, and now I'm short stock, and the stock ends up rallying, doubling in price over the next year. I mean, it's kind of far-fetched. Nobody should put themselves in that position, but it's probably a good lesson for novice traders who don't really think about these things. Like, this is not the kind of strategy where you put it on and 3 years later you say, "Hey, Martha, whatever happened to that calendar spread we put on back in 2020?" You kind of have to manage it a little bit.
Yeah, these are definitely not set it and forget it type trades. Carmela has a question up here, which is interesting. She kind of raises the specter of an event we all just witnessed, we all just lived through, that could maybe make you think differently about time spreads. She asks here, we're all living in a post-WTI world right now. That is indeed true. Carmela, do you think we'll see more commodity products trade negative in the near future? If so, does that change how we think about risk for supposedly, quote, limited risk trades like time spreads? That's an interesting question, an interesting point, because that WTI plunge to the dark side there really changed the way a lot of people look at a lot of things going forward. They looked at how they price risk. We saw CME Group adding negative strikes for the first time, I believe, ever in that exchange's history. Not exactly a precedent we want to see repeated out there, but they have come out and said, they think that was orderly working of the marketplace. Other folks have disagreed out there. I think you could easily take a counterpoint. If there were traders out there to backstop those markets in the pits, would that have happened? That's an open question, an interesting debate that we have had on some of our other shows, and I'm sure once all the madness clears and the trading floors come back, that will be a topic that is brought up again. And so you're right. I heard from many people, Carmela and others, Russell Rhodes is on this network not too long ago saying when he saw that front contract get down to about 22 cents, he's like, well, I'll just take a flyer on it. Why not? Most I can lose is 22 cents. And no, it actually went $40 into the negative territory. So you have a time spread where that July contract was trading, I think, around $20-something at the time, and the front contract went to negative 40. So a time spread that you thought could really only be not that much, all of a sudden went to almost 70 handles. So these are the insane scenarios. As Dan was kind of just alluding to, it does take some of those aberrant scenarios to make these time spreads start to get a little bit funky, a little bit crazy. But it does raise a very interesting question. I'm sure, Mr. Matt, you don't usually talk a lot of futures out there, but I think everyone paid attention to that WTI going negative because it was so just completely outside the pale for what most people normally expect. Has that made you, like Carmela suggests, has that made you rethink some of these types of strategies like time spread in light of the risk in certain commodities that this could happen again, sir?
This is a good question, and it made me think about something else. And we should talk about it a little bit, because time spreads, we're talking about time spreads on equity options, and we're not talking about time spreads on futures related underlying. So, for example, even the VIX, a time spread, really, some of the rules that we're talking about, those rules don't hold. So so this is a really good clarification by Carmela, that some of the rules that we've talked about on max loss don't apply for when you have an underlying futures contract or an index like the VIX or SPX. So you have to be careful on these things, because what will happen, in the WTI, you'll have one where the future can now we found out, I didn't know that, could go negative, and you'll also find that time spreads have different margin treatment on futures options, and because they don't have the same type of relationships that it just throws another wrench into it. So for the person learning about it, I would avoid time spreads on futures options or indexes like the VIX right now. Like that type of a time spread has some idiosyncrasies around the various futures contracts exercising. So I think it's a good question from that. Yeah, I mean, definitely. And just speaking about WTI, I had a front seat, but I had USO, so I wasn't in trouble. But some of those people that were trading the futures, had a very rough time of it. They learned that there weren't enough swimming pools to put oil at the West Texas Intermediate there in Oklahoma. So that's one of the drawbacks about trading futures, I suppose, where we don't really have those issues, Mark, with ETFs or stocks.
Unfortunately, that music for Carmela and everyone else out there means we've come up against it. But you're right, Matt. These are not traditional time spreads. We're talking about a stock usually, and that's one underlying. A time spread on a future is now multiple underlyings. In the case of WTI, you had that June future and that July future. I think it was May. It might have been May and June future at the time. So those are two different underlyings. So it's not quite the same thing, hence why you could have that crazy dichotomy. You're not going to have a stock go negative in the front month and still be positive in another. That's not going to happen. So a little bit of a different beast out there, which is, again, I think Matt's advice to maybe be cautious if you're new to time spreads around the commodity space might be a good one. That's a good topic, though. It might be worth addressing again on a future show. Unfortunately, that music means we've come up against it. Man, this show flies when we're having fun. But before we go, let's go back around the horn. Let's start with the black-hatted one. Mr. Dan, if folks want to learn more about all this stuff, it's obviously a lot of questions about time spreads. Maybe hint, maybe it should be a time for a time spread course over there. Where should they go? What should they do, sir?
Yeah, hey guys, you can find me at markettaker.com, and would love to help out any way I can. If you have a question, fire away. Glad to help.
There you go, markettaker.com. Don't forget the second T for Theta over there. Markettaker.com is the place to go to learn more. Clearly you have questions about time spreads. Mr. Dan can help you out. And Mr. Matt, sir, it's hard to believe 2 episodes have already flown by, sir. It was a great fun having you in the NASDAQ hot seat. Luckily, I don't have to wait too long for my next taste of the ORATS goodness. That's going to come up on the advisor's option. If you're listening live, check out that show tomorrow live. That'll be a fun one as well. And Mr. Matt, in between those episodes, if they want to check out what you guys have cooking over there in the land of ORATS, and maybe you want to give them a little bit of a hint, a little bit of tease of what you're working on, sir, now is the time. The floor is yours.
Well, Mark, it's great that Option Insider has all this content. I wish I had it back when I was learning, but it was a pleasure to be on. At ORATS, we have, like I said, backtesting is an educational tool. So when you're looking at strategies, check it out. Try to put them together in our backtester, and you'll get an answer in a couple minutes. And then when you do like a back test, you could press scan, and the current options come out. And if you like those, you could paper trade them, and we have it all the way. So come on over to orats.com. My email's matt@orats if you have questions. Happy to be here. Happy to help, Mark.
We're happy to have you in the NASDAQ hot seat. Option Rats is his handle on the Twitter machines, or just ORATS, ORATS.com is the place to go for all that goodness. He mentioned the back test, the earnings reports, the dividend reports, all that good stuff. ORATS.com is the place to go. And, of course, if you want to read more about his stuff, Little Birdie told me he's putting some stuff over there up for our friends over there at NASDAQ. NASDAQ.com, of course, the place to go to get all the analysis. You want more information, Scott and everybody else, what's going on with the Philly? That's the place to go, as well as analysis from Matt and Russell. And just about everybody else who's been coming in through the NASDAQ hot seat of late. They have articles and analysis for you over there. NASDAQ.com is the place to go. And on behalf of our friends over there at NASDAQ and Mr. Matt and the black-hatted one, Mr. P, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, for listening live. Remember, live is a way to get this show even earlier than on the podcast. And we'll see you back here next time for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ. Tech forward. Leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.